Hello everyone, welcome back to Stock Market Meridian. Today is 10th August 2026 and you're watching today's post-market report. Let's begin with today's market action. Today, the Indian market opened almost at yesterday's closing level. Throughout the trading session, markets remained largely sideways with limited movement on either side. And finally, both major indices ended the session in a completely neutral zone. Coming to the sectoral performance, today's top losers were the PSU Bank and oil and gas sectors. On the other hand, the Realty and private banking sectors emerged as today's top gainers. Now, let's quickly dive into today's top news and updates. The Government of India has revealed that customs duty collections from precious metal imports crossed rupees 10,460 crore following the sharp import duty hike implemented in May. Minister of State for Finance Pankaj Chaudhary provided a written update in the Lok Sabha regarding the revenue generated from precious metal imports. According to the government, 10,463 crore rupees in customs duty was collected from gold, silver and platinum imports between May 13 and August 2, 2026. Gold imports contributed the majority of this revenue at around 10,040 crore rupees. Silver imports contributed approximately 328 crore rupees, while platinum imports added around 95 crore rupees. This increase in revenue comes after the government raised the effective import duty on gold and silver from 6% to 15%, while the duty on platinum was increased from 6.4% to 15.4%, effective May 13. The higher import duties have also resulted in increased enforcement activity at customs checkposts. Between May 13 and June 30, customs agencies registered 287 cases of illegal gold imports. Authorities seized around 160.91 kilograms of smuggled gold and arrested 116 people. Meanwhile, regarding the amount of unused gold held by Indian households, the government clarified that no official data is maintained on household gold holdings. The government says the duty hike was aimed at controlling discretionary bullion imports, conserving foreign exchange reserves, and managing the current account deficit. Moving ahead, the Ministry of Petroleum and Natural Gas is also in focus today. Minister of State Suresh Gopi informed the Rajya Sabha about several important decisions regarding ethanol blending in diesel, petrol, and alternative household cooking applications. The central government has officially ruled out blending ethanol with diesel following technical and safety evaluations conducted by oil marketing companies. Research and development studies conducted by public sector oil marketing companies or OMCs found that blending ethanol with diesel can significantly lower diesel's flash point, and that creates a major safety concern because a lower flash point may fail to meet mandatory fuel safety standards and can create handling and operational risks. The government also reiterated that no decision has been taken to increase ethanol blending in petrol beyond the current 20% E20 target. For ESY 2025-26, OMCs allocated around 1,048.5 crore liters of ethanol to 378 suppliers against total offers of nearly 1,760 crore liters. However, while ethanol blending with diesel has been ruled out, the government is now exploring another possibility, using ethanol as an alternative clean cooking fuel. The government is promoting research and development to explore ethanol-based cooking technologies. This could potentially help absorb surplus domestic ethanol capacity while also reducing India's dependence on imported LPG. The LPG Equipment Research Center, or LERC, a joint undertaking of IOCL, HPCL and BPCL, is leading research and development in this area. Next, Oil and Natural Gas Corporation, or ONGC, is in sharp focus. State-run ONGC has signed a non-binding memorandum of understanding with Shell Energy India to evaluate joint opportunities in offshore exploration and LNG sourcing. The partnership aims to combine ONGC's strong domestic presence with Shell's global deep water capabilities. Under the agreement, both companies will explore potential participation in deep water and ultra-deep water blocks under the government's Open Acreage Licensing Policy, or OALP. They will assess opportunities in ongoing OALP rounds X and 11, as well as future bidding rounds under the broader Samudra Manthan initiative. The MOU also allows both companies to evaluate potential farm-in and farm-out opportunities on ONGC's existing OALP acreage. However, investors should note that this is only an evaluation framework at this stage. The agreement does not commit either company to any specific financial investment or expenditure. Another major focus area is LNG sourcing. As India works towards increasing the share of natural gas in its primary energy mix, ONGC and Shell will explore joint opportunities for international LNG sourcing. The objective is to meet growing demand from sectors such as city gas, fertilizers, power, and industries, while also diversifying India's imported fuel sources. This agreement further strengthens ONGC's partnerships with global energy majors, following earlier agreements with companies such as ExxonMobil and Chevron. Next, Dabur India is in focus. focus. The maker of Real Juices and Dabur Honey has filed a writ petition in the Delhi High Court against the Food Safety and Standards Authority of India or FSSAI over its crackdown on products carrying 100% marketing claims. Dabur has challenged an FSSAI prohibitory order that restricted the sale of 11 flagship products carrying 100% claims. According to Dabur, the order puts approximately 150 crore worth of inventory at risk. The company has argued that FSSAI acted in a mechanical manner without properly examining the labels. Dabur also pointed out that some products, including Dabur homemade coconut milk and cold-pressed sesame oil, never carried a 100% claim on their packaging. The company further argued that the regulator issued the prohibitory order without first giving Dabur a show-cause notice or an opportunity to explain its position. Dabur has also questioned the regulator's reasoning that 100% pure claims can disparage competing products. The company pointed out that similar 100% terminology is used across the industry. The regulatory action had an immediate impact on retail and quick commerce platforms. For example, Blinkit disabled listings for the affected Dabur products following public announcements by the regulator. Some hotel chains also asked Dabur to identify and exclude the affected products until the regulatory issue is resolved. However, there is some relief for Dabur. The Delhi High Court has granted interim relief to the company by staying the FSSAI prohibitory order until August 24, 2026. The court observed that the regulator should have heard the company before passing such directions. Dabur has also confirmed that it has already transitioned or is in the process of transitioning most product labels and advertisements to remove the 100% claim. Next, Zee Entertainment Enterprises is in sharp focus. The broadcaster has approached the Delhi High Court against Nykaa and quick commerce platform Blinkit, alleging copyright infringement involving Instagram Reels. At the center of this dispute is an important question for digital brands. Does access to Instagram's music library automatically allow commercial businesses to use those tracks for product promotions? Zee Entertainment argues that the answer is no. According to Zee, its licensing agreement with Meta allows individuals to use its music catalog for personal and non-commercial posts. However, when commercial brands use the same music to promote products, Zee argues that it becomes commercial exploitation, requiring a separate commercial license. In its case against Nykaa's parent company FSN E-Commerce, Zee is seeking around 2 crore rupees in damages for the use of its music across 12 promotional reels. Nykaa has deleted the flagged reels and has requested the court to make Meta a party to the case. The company has also argued that Instagram's built-in music library is available as a standard feature to users. The Delhi High Court has issued summons to Blinkit, directing the company to file its written statement within 30 days. The court has also allowed Zee to submit screen recordings as evidence. The next hearing in the case is scheduled for August 27. This case is part of a broader trend of media companies taking action against commercial brands over the use of copyrighted music without separate commercial licenses. Now let's move to some important company updates. First up is BEML. BEML reported significant year-on-year operational improvement for the quarter ended June 30, 2026. The company's consolidated net loss narrowed by 58% year-on-year to rupees 27.01 crores, compared with a net loss of rupees 64.11 crores in Q1 FY26. Revenue from operations increased by 29.2% year-on-year to rupees 819.62 crores, compared with rupees 633.99 crores during the same quarter last year. Total income also increased by around 27.8% year-on-year to rupees 821.19 crores. However, sequentially, the company moved into a loss from a net profit of rupees 179.82 crores in Q4 FY26. This sequential decline is partly related to the company's usual seasonal strength during the fourth quarter. Following the earnings improvement and strong order inflows, BEML shares jumped as much as 7.19%, reaching an intraday high of around 1,916.50 rupees on the NSE. The company continues to maintain a strong order backlog, providing long-term revenue visibility. BEML secured new orders worth around 1,181 crore rupees during Q1 FY27, representing a massive 172% increase compared with rupees 435 crore rupees in Q1 FY26. The order inflows were led by mining and construction, rupees 589 crores, defense, rupees 581 crores, and rail and metro, rupees 11 crores. As of June 30, 2026, BEML's total order backlog stood at approximately rupees 16,284 crore rupees. Next, JSW Energy has significantly expanded its generation generation portfolio through both organic renewable additions and inorganic thermal acquisitions. Since April 2026, the company has added around 1,166 megawatts of renewable capacity and 300 megawatts of inorganic thermal capacity through the acquisition of Maruti Clean Coal and Power. Interestingly, the renewable capacity added since April represents more than 94% of the total organic capacity added during the entire FY26 financial year. These additions have taken JSW Energy's total installed operational capacity to approximately 14,920 megawatts or 14.9 gigawatts. Renewables now account for around 60% of the company's total installed capacity. This includes 3,125 megawatts of wind capacity, 2,360 megawatts of solar, 1,696 megawatts of hybrid capacity, and 1,781 megawatts of hydro capacity. Thermal capacity currently stands at around 5,958 megawatts. The company has also confirmed that it remains on track to achieve its 3 gigawatt greenfield capacity addition target for FY 2027. Beyond its current operational assets, JSW Energy has a significant pipeline. The company's total locked-in generation capacity stands at approximately 32.4 gigawatts. That includes 14.9 gigawatt operational capacity, 13.5 gigawatt under construction, and another 4 gigawatt pipeline. The company also has around 29.6 gigawatt hours of locked-in energy storage capacity. This includes 26.4 gigawatt hours of pumped hydro storage and 3.2 gigawatt hours of battery energy storage, or BESS. JSW Energy aims to reach 30 gigawatt of total generation capacity and 40 gigawatt hours of energy storage capacity by 2030, with a long-term target of achieving complete carbon neutrality by 2050. Now, let's cover some of today's important quarterly results. Starting with Bharat Forge. Revenues improved on both a yearly and quarterly basis. EBITDA also improved on a yearly basis. However, EBITDA margins and net profit declined on both yearly and quarterly basis. So overall, the results were weak. Next is Hindustan Copper. All major earnings parameters improved very strongly on a yearly basis, although they declined on a quarterly basis. This sequential decline can be relatively common because of seasonal factors. Overall, the results were good. Next is AstraZeneca Pharma. Here, only revenue improved strongly on both yearly and quarterly basis. However, earnings parameters such as EBITDA, net profit, and margins declined strongly on both yearly and quarterly basis. Overall, the results were bad. And finally, InfoEdge. Net profit and net profit margin declined on a quarterly basis. However, the remaining earnings parameters improved very strongly on both yearly and quarterly basis. Overall, the results were good. So that's all for today's post-market report. If you found this video helpful, don't forget to like this video, share it with your fellow investors, and subscribe to Stock Market Meridian for daily pre-market and post-market analysis. I'll be back on Tuesday morning with another detailed pre-market report before the markets open. Until then, thank you for watching. Signing off, Jai Hind.